Hi viewers, this is Rashid, your business and financial consultant. Uh, First of all, I would like to thank all my viewers and giving us a very positive feedback and asking us different questions. Um, Today's video is actually based on your own ask. Many people ask about it, and it's a very important topic today. We are going to discuss about the commercial mortgage and people want to know what is a commercial mortgage because many people know about the residential mortgage, but how to go with the commercial mortgage is a different it's a different scenario. So we'll talk about this important issue today, and we'll take you step by step towards the end of this, how to accomplish this deal. And just like before we have done, we have actually another presentation today to show you. So we'll show you another presentation so that it gives you better uh, point of better view to understand how these mortgages and systems work. So commercial mortgage actually it could be a gas station, it could be a restaurant, it could be a shop in a mall or maybe in a roadside way, or it could be a residential building, it could be a factory or with the machinery or things like that. So these are the one of some of the example that commercial mortgage is coming to the action. So we'll talk about step by step what is the commercial mortgage. So a commercial property mortgage is usually a long-term loan that provides the cash ability to purchase a business premises. The mortgage lender will typically lend up to 70% or less. What happened that some lenders go for actually for a down payment of 30%. If they are asking for 30% down payment, then it's a 70% LTV. But sometimes they go for a less LTV for maybe 65% or 60%. Then they ask for 35% down payment, and in some cases 40%, or maybe in some cases even 50% as well. Depending on case to case, there's no hard and fast rule. Usually, the higher down payments is being asked to either a risky business or people those have less expertise and experience regarding that particular business. So the business okay the typically lend up to 70% or less of the property's value, leaving the business to pay its regular mortgage payments and utilizing the working capital to fund the growth. So next is a documentation. It's again a very important point that what documentations are required in commercial mortgages. So any potential buyer is subject to provide certain financial document. These usually extend are um, there are 3 years of tax account, T2 generals, and notice of assessments. Tax papers are considered basically either it's a T2 general in case of commercial mortgage, it's a T2 general, and um, no notice of assessments. Just want to let clear at this point that in personal when we apply for personal loan or mortgages, then they ask for, then T1 general is considered for a personal property of personal loan. But when we talk about the business and commercial loans, they ask that particular business T2 general. So current and projected performance figures. So what is your current situation? How you are doing at this point? What are your um, incomes and expenditures, and what are your profits and losses? And what is you thinking about going down the line? Maybe 1 year, 2 year, 3 years. It's a step by step projections that you want to They need to know what is your future plan uh, about your business. And bank statements, how much is retained equity and other things are there. I mean, in the bank accounts, what are the transactions are going on. Details and profile of all directors and partners of the business. It's again very important. You see what happened that lender want to know who will be behind this business, like what are their expertise and what are their experiences. Suppose, just take an example, if someone wants to buy or run a restaurant, then should not be any other than a chef. That is the best scenario in case of restaurant or food business, so that the person have this experience and expertise. If other than this person is sitting there, then there is a possibility and there are chances that that will that person will take a little time to understand the business, and may not be knowing ins and outs of the deeply about that business. And the assets and liability statements, of course, what is the differences between assets and liabilities. Are either you are in a positive stand, your business stand positive or negative. Then there are reasons and benefit why people apply for this commercial mortgage, and what are the advantages of this commercial mortgage. There are a number of reasons and benefits to choosing a commercial mortgage. Mostly it is seeking future source of funding and finance. So what happened that people think about down the line, they have many plans. So what are those plans? We'll let you know. We'll talk about that. Capital for investment or growth. So if you are already running your own business at this current time, you might want to expand your business, or you want to invest more money on the same business for some reasons. Then you go for this commercial mortgage. Or want to consolidate your business debt. It also a reason. Sometimes they already have obtained enough loans, and there is an equity generated in their property, or they want to have a one single payment for different lenders. So they want to go for, they consolidate their debts and they pay the one single payment to one lender. So this is a consolidation of the business debts. Repair or replacing new equipment. Yeah, again, a common scenario. When you have a business equipment, with the passage of time, wear and tear happens. Either it becomes obsolete, it becomes repairable, or sometimes it's obsolete. So you want to either spend money repairing or adjusting the problems in the current equipment, or in some cases you want to buy a new one replacing from the old one. The other one is inventory or expanding trading. Again, if you are maybe stock business with the stockholder, and then you need to know, you need to have some inventory in your business, and sometimes they run out of this inventory because they have bigger orders for their business. So they want to establish and grow their inventory. So they want to buy more goods. So this is the reason they apply for this commercial mortgage, or they want to expand their business as well. And the other thing is that buying is cheaper than renting. What happened that business commercial people, commercial businessmen, or people those are in the business, their preference is actually buying a property. There are a number of reasons for buying a property. That down the line, it happens that equity is being generated in their property, so they can utilize that equity instead of borrowing from outside. They take out money from their own property and use this money for a number of their reasons. And then it is, this facility is actually not available in the renting situation. So they avoid renting until they have enough finances available for this buying up their own building or property. And the other reason for buying up property is that option for subletting or leasing parts of the property to certain ancillary income. So what happened that in some cases uh, the business have some extra space available in their building in their business property. So they instead of just leaving that vacant or unutilized, they make a portion, a partition on that, and they sublet actually to another business or another person. Is in this situation they have a cash flow betterment, and an income starts, an extra income starts coming in to their business. And now we talk about the terms. Um, in commercial, in personal mortgages, terms are 5 years terms usually as a common case, and their amortization is 25 years time. But in commercial mortgages, we have a 5 to 25 years term. So loan are given from 5 to 25 years term period. It is payable until the 25 years time. But in some cases, or in some lenders, they extend their loan repaying period from 25 years to 30, 35, or in some cases 40 years time, depending on the case to case and lender to lender situation, which is not very common anyway. So interest rate almost the same, fixed or maybe a variable depending on the case. Usually the the loan for the property and for the equipment is a usually is a fixed interest rate, but for the cash flow and other thing is a variable. um, tax tax is again, tax is actually the same situation as the individual mortgage. You can reclaim the tax payment, interest payment actually, interest payment on your tax for this to have a tax deduction. Now we'll talk about actually 8-10 very important steps that needs to be taken and to be considered before applying for this commercial mortgage. So we'll talk about what are those important steps one by one, and we'll see what comes the first. The first step is assessment of finance. It's very important. Do you have the power to repay your monthly payments? Because most lenders require evidence that your business can repay the loan. It's important. When you apply for the loan and you submit your business documents, the main thing they look in the documents is their power to repay their loans. If that you are generating enough income that if they lend you money, you have enough income coming in so that you can start repaying the loan and you will not have any difficulty. You need to show that your finances can support your mortgage payment, so that your finances are strong enough to support your mortgage payment. And you should consider the maximum amount to borrow that your business can afford to repay per month in payment. What happened that instead of applying in parts, suppose you need a 10 million for any reason, a commercial mortgage. Instead of applying 5 million one time or 5 million again, you should go for one time in a go, one go, so that what happened that when you go again and again to a lender, it does not create a very positive impression. It gives the lender impression that probably you do not know about your finances, and or either you do not have projection about your future, about your business future, that how much is going to be expand and how much is your requirement. So it's better to go for one go in a one amount. Step 2 is property suitability. Again, very important. Knowing needs of your premises for your business is not less than winning half the battle. You also need to know about what you need from that premises. Size is important, but so are your health and safety requirements. Uh, what happened that you should knowing according to the what kind of a business you are doing. If you are doing some industry kind of a business, then it should be located in a industrial state or industrial environment. It's better instead of looking someplace maybe in a residential or close to residential area. That is not the right thing. Or if you are looking for a some merchant way, then you should look for some mall or retail area. If you are transporting your products or looking to attract customer, then you need to ensure it is easily reachable and close to transit points. You should be thinking that if it is a retail area, your customers you targeting a common customer, common person to come to your sale of point, then it is better that your shop or your outlet should be near the transit points, either buses, maybe go station, or maybe a subway or any transport that anyone can reach and to that point, not necessarily the person who is driving only. Then creating a list of key requirement is a good starting point and will help pinpoint suitable location. So the bottom line is that before going for a property, you need to sit down and jot down your need and requirements, that what are you looking for actually, what is your requirement. And then what happened that when you go to visit your proposed building or property, then you match your requirement with that property, that is it the one that I have mentioned in my requirement, is it matching, this building is matching with those requirements or not. So this will help you selecting the right property or suitability. So step 3 is a finding right matching lender. Again, once you have prepared all those things, then you look for the right lender. So there are many types of lenders to approach when considering a commercial mortgage. It isn't necessarily on the high street that you'll be find the best rate or the best deals. You can certainly approach your bank or other commercial lender, but be aware that there are many specialist commercial brokers that can access commercial finance for specific business sector, including the one you working in. So what happened that instead of it is recommended, not in every case or in all time, but it is recommended that you should consult or talk about your commercial mortgage broker. So that what happened that those commercial brokers, some of them have wide range of lenders available to them from different fields. Like some are investing in a commercial property, some are investing in a commercial equipments, some are investing in a maybe transportation and other. So they know those lender, those brokers, commercial brokers, mortgage brokers know which type of deal to send and deal with which to which lender. So this will help you instead of going door to door and many lenders, wasting your time and energy, and maybe sometimes people get disappointed and frustrated in this going through this exercise. So this will help you to contact your brokers. You can often find deals that you probably won't be able to find or access without their help. So what happened that sometimes those brokers already have the information that that particular lender is nowadays having this kind of a deal available, or this kind of a promotion going on with this lender. So this will help you actually obtaining the right amount and commercial loan. So again, a very helpful point going through the mortgage broker. The next step, or step 4, is your company cash flow. Your business will need a cash flow in order to survive and thrive. Uh, Cash flow enables your business to pay bills, expenses, wages, and for taking advantage of growth opportunities before applying for a mortgage on a commercial property. Assess your cash flow to help identify and predict how the cash in your business changes over time. Is it seasonal? Bear in mind, all lenders will require evidence of cash flow and forecasts, so it is essential you understand that access to cash flow will have at any given time. So lender know that besides your assets and liabilities, your cash flow, how much money is coming in and going out on a monthly and weekly and annually basis. So they know that this is the transactions and money is in the role. So this will help them to assess your worthiness and your that you will be paying your expenses, your wages, so that there are enough money is in the role in your business. This is a very important factor uh, that lenders look at when they lend you money for a commercial mortgage. And now it comes to the point for creating a business plan. Most lenders will require plenty of information before they consider lending your large amount of money. See, the commercial lending is not a couple of $100,000, maybe $500,000, or just $1 million. In commercial lending, there are multi-million-dollar deals. Sometimes it's 50 million, sometimes it's 100 million, sometimes it's more than that. So when they are lending this much high money, they ask too many questions, too many documents. Here is where you define your business. What type of business do you offer, and what are you doing to make it success or become more profitable? If it is a new business, then it will be important to ensure that you have all the relevant permission, for instance, pub licensing, etc. The more details your business plan and projecting your more confidence projection, the more confidence lenders will display. So what happened that the more you tell them about yourself and your business and your abilities, so and in your business plan, that you will be doing in the first year you will be doing this, second year you will be extending and expanding your business to growing your business to this level, and third year you'll be taking your business to this level. Then the lender know that you have a growing plan, and they assess that if the viability of that plan, how much is that viable, and the if this plan is viable, how much you will be getting in return, how much money and income you will be getting, and in result of that, their amount of money they are lending is a secure, and you'll be having ability to repay. That's the bottom line actually. So they want to ensure information about your business information, what kind of business you want to do or you are doing, your expertise and abilities, what have you done in the past, and what are the results, what results happened with your operating those businesses, products and services, which products are you dealing with, it's a consumer product, it's a exporting company, it's a manufacturing company, things like that. What are your target customers? Like some consider um, just take an example for smoking cigarettes. So they target about the smokers, and some consider like their business maybe for their particular requirements. So they target what kind of your target customers are going to be. Your products and pricing, how much your products will be costing in the market, so that they know that it's not your product is not out of the reach of uh, the customers, so that they can easily access your your customer can access easily those or buy those products. Your future business development planning is also very important, that how you will be developing your business in future. So step 6 is a commercial credit report. uh, what happened that just like a, personal business personal credit report, they also want to know about your personal credit report as well. But they also want to they need to know your commercial credit as well. Lender want to know your company credit reports besides your personal as well, but also other information that will identify the financial stability of your business. This may include pay slips and 3 or more years worth of company accounts. While it is often thought that only those with the perfect credit can obtain a commercial mortgage, those that don't should that those that shouldn't give up uh, going above and beyond to prepare your financial accounts and projection can also convince lender you are worthy. However, it is common sense to ensure any credit issues are resolved before applying. So what happened that when they pull the credit, they want to know about your past, how you were paying, how's your repaying with the other lenders or in your past loans status. So you should be uh, providing all this information, and you should be having up to date on your credit reports as well, so that it gives an edge lenders or willingness to give you money. The key stakeholders details. Lenders need to know who will be involved in the business and who is responsible for paying and making the repayments. This means providing the personal details of the key stakeholder in the business to be credit checked. This includes the assets and liability statement for each applicant. Be honest and complete in who owns how much of the business and who is ultimately going to be responsible for satisfying the financial commitment. So when they the lenders lend the money, they go through the profiles of each and every partner or anyone who is a stakeholder in that business. So they want to know their personal details, what is their background, what is their expertise, and what they have been doing, and with relation to that business, so that this this helps lenders to make decisions about your business. So the last and not the least is closing cost and other fees that you should consider before applying this commercial mortgage. Taking a mortgage on a commercial property will also mean being hit with other fees and costs. You will need to consider a valuation fee, like a appraisal kind of things, and legal fee. You must also think about possible redemption fee if you decide to repay off the balance of your mortgage early, and transfer fees, etc. The more important you can provide, the better. The more information you can provide, the better better when you applying for your commercial mortgage application. Lenders loves asking questions, and having to handful and complete answers make your mortgage application more likely to success. So you see that just like a personal mortgage, the commercial mortgage also has a closing cost, and that has some maybe some fees and charges. So you should consider that in your expenses or cost of borrowing that loan. But you can also write off those expenses and expenditure in your taxes. You or with the advice of your tax consultant, that is to them. So this is basically step by step. It was a inside look of the commercial mortgage that we talked today. And before at a conclusion, we would like to explain our services. We offer commercial mortgages. Um, we offer residential mortgages, refinancing of mortgages, private mortgages, first and second, good credit, bad credit, we have no problem. New immigrant to Canada, first time home buyer, debt consolidation, debt removal, team of professionals we have, actually accountants, lawyers, and real estate professionals as well. So we have a one window operation. You will not have to run from pillar to post for one thing, another thing. We'll provide you all the information here. This is my company name, xbanker.net, business and financial consultant. You can call me on my number 647-300-3304. My email address is xbanker.net. My website is xbanker.net. I'm a licensed mortgage professional, and we are ex-banker. We are professional. So you can reach me anytime when you decide to go for this commercial mortgage. And thank you very much again for watching and taking interest in this video. We will be waiting for your feedback. Feel free to send us email or your messages. Thank you very much, and stay safe and have a nice day. Bye-bye.